How to get rich slow. This is a bit of a counterintuitive approach because these days a lot of people are just looking at how to get rich quick. Yeah, you win the lottery, you go leverage, you do trading, right? And a lot of different type of stuff lah that people sell to you and tell you that you can get rich within like X months or 1 year, you become a millionaire already. But today's session is to educate you guys on how to manage your money more sustainably based on what I learned from Hans' financial planning session. It's a 4-hour crash course conducted on the 26th of April. Now, the recording itself has been posted to all our members. It's almost 2 hours long, as you can see over here. So today's session is really just going to briefly summarize the important points that Han has covered and give you a rough takeaway on how financial planning looks like. So Han did not mention this, but what I really got out from his entire session is we focus on building practical and impactful habits. Yeah, we want to rely very little on luck. We want the luck to come to us naturally. But put it this way lah, in 1,000 parallel universes, you want to be wealthy in 999 of them. Yeah, through your impactful habits lah. And you can think of it as like building a castle brick by brick. Yeah, at the start, you don't really see a lot of results, but those habits, they will compound, and over the next 5, 10, 20 years, right, you will see it make a significant difference in your life. So no shortcuts. I'm not going to sell you any get rich quick schemes. Yeah, those are just people getting rich quick off of you. Okay, and we will focus on what are the sort of things that we can look at every month in order to better our budget, invest better, and also retire more comfortably, hopefully. So financial planning is divided into three very simple steps. Now I say it's simple, doesn't mean it's easy lah. You start off by assessing your current situation, yeah, i.e. how much you're currently earning, how much you're spending, who you are, what you're working as, etc. etc. It's sort of like a biography of where you're currently standing. Then everybody has a variety of goals, right? Essentially, any type of goal you have today, it is sort of like a financial goal. If you think about it, it makes a lot of sense, right? Because these days, almost everything needs money. Lah. Your Japan trip, your new car, your wedding, your down payment for your house, right? These are considered financial goals as well. So you decide them and then you segregate them, either it's short term or long term. And then finally, you chart a sustainable path in order to achieve those goals. So the first step sort of looks something like this. This one is directly poured over from Hans' slides. So Wong needs help, right? He's a software engineer. He's 25 years old, just bought a new car. He earns 6,000 ringgit per month, which is quite decent actually. He's saving for his first house. He plans to propose to a partner. So your first step in financial planning should look something like this, where you create a mind map of yourself to really understand what your current situation is. Then you move to your next step, which is defining your goals, whether it's a long term or short term. Now, typically as humans, we can only look at the very short term. Yeah, at the most, the next 3 to 5 years only. So when you plan your goals, right, what you'll notice is you will have a lot of those that are short term, those below 5 years, i.e., buying a new car, house, new handbag, Japan trip, right? And one very long term goal, probably one or two only are maximum, but the most common long term goal is comfortable retirement, where you decide an age where you want to stop working, let's say 45, it's a bit early, but maybe 50, 55, right? And considering your current age, hopefully you guys are about 25 to 30, around that ballpark right now, you have about 10, 15, or 20 years, right, to invest for your retirement. Now, one of the first biggest mistake that people tend to make is that they mix up their retirement as well as short-term portfolio. Right? They don't even have a pie chart itself to break down what investments they currently have. So a pie chart looks something like this. They just invest according to whatever that's hot in the market right now, whatever the people is currently saying, and you end up very messed up on what you really want. yeah, in terms of your retirement, your short-term goals, or whatsoever. Now, some people may even go that extra step further and invest into risky assets using their Japan trip fund. And you wouldn't want to do that. That's one of the worst things to do. Let's say you decide to go all in on Bitcoin right now because Bitcoin looks pretty healthy, right? Currently sitting at $96,000. And you say that, oh, the trend will only go up. Let me put 100% of my Japan funds into BTC because if it appreciates by 20% in the next month, wow, I got 12,000 ringgit instead of 10,000 ringgit already. Well, obviously that is a big no-no because over the short term, Bitcoin is considered a very volatile asset. It has declined by almost 70% in less than a year. So imagine you start saving up for a short-term goal somewhere over here in late 2022, not seeing that it may go through a bear market, you lost 70% of your value. So that 10,000 ringgit for your Japan trip suddenly becomes just 3,000 ringgit. And very sadly, you can no longer afford that short-term goal. Which is why don't ever mix up retirement as well as short-term goals. Now, conversely, let's say you have a long-term portfolio, right? You say, okay, I put 5, 10, 15% of my portfolio into Bitcoin and I plan to invest it for 15 to 20 years. Now, even though you started at the same time, right, in late July or late 2022, right now, it will be up by 56%. So time frame is important over here. If you have a longer time frame, you can afford to invest in riskier assets. You can afford to weather this volatility. If you have a short time frame, you're saving up for a down payment for a house, down payment for a car, this is something that you don't want to do. Okay, so short term, before 5 years itself, we no longer call it investing, we call it saving up for something already. Okay, which is why your portfolios will look something like this. One giant retirement portfolio is separate from many different short-term goals. Now, each of these are considered a separate short-term goal as well because saving up for a down payment for a car in the next year is different compared for saving up for a down payment for a house in the next 3 to 4 years. Right? Again, you cannot afford to lump it all into one section. Okay, so my one currently looks like this. So I typically don't show my portfolio to the public. It's only shown to our Patreon members and I update it once a month. So it's invested in a healthy mix of risky assets as well as safe assets. If you're wondering, okay, what's the percentages that I tend to look out for? Well, I'll explain it shortly later. But my goal is right here, right? I plan to retire at the age of 55 and this is my long-term portfolio. Now, short-term wise, I have a lot of things. This doesn't even cover the things that I want to achieve in the short term. Right, I'm currently using Aeon Bank, gives me about 3% per annum. Not the highest earnings rate, but it allows me to segregate my savings. So it's more organized in a sense. That's why I tend to prefer digital banks or cash apps that offer savings pots. So you can, make it look neat, something like this. So moving on, the next biggest mistake to make, well, a lot of people have said this many times before. Save up your emergency funds, right? And why is this the case? Well, you wouldn't want to liquidate this portfolio at the worst time. Right? Let's say right now, because of Trump's tariffs, markets are down quite a bit. Your portfolio, let's say, is down 20 to 30%. But because you didn't save up sufficient emergency funds, your car break down, you cannot afford to pay back for that service, right? You have to liquidate this section over here at this time. So that really feels bad, right? Which is why you can basically ignore what I said previously if you don't have a sufficient buffer for your emergency funds. Okay, so that should be your utmost priority. Save up 3 to 6 months worth of your income, not your expenses. So what previously some people have been saying is, oh, 3 to 6 months of your expenses is enough. But Han actually went a step further and said that, hey, no, it's 3 to 6 months of your salary. So in case you get laid off, imagine you still get paid for the next 3 to 6 months. Okay, so if you earn 5,000 gross per month, your emergency funds should at least be 15,000 to 30,000 ringgit. And this is the first most important step. So obviously next one is, well, you don't put your emergency funds into risky assets because like what I showed you guys just now, these things happen, you don't want your 30,000 ringgit suddenly become 10,000 ringgit, right? And that's something else to feel bad about, okay? So let's say you got your emergency fund sorted out already, then you set your short-term goals, you say rental deposits, new Myvi, then you define your long-term goals already. Okay, Shinji says this, Han says that. But then how do I invest towards my long-term goals, right? And for that, we use the rule of 100. So I'm going forward a bit. So I want to just backtrack a bit about emergency funds. Okay. So FYI, emergency funds, where to store them, right? It has to beat inflation. These three boxes, it has to tick. Then it's only considered as a good place to store your emergency funds. Number one, beat inflation, meaning that it has to generate at least 3% per year. Lah. Okay. Best case scenario, you put inside EPF account 3, it gives you 5.5 to 6% per annum. So inflation is about 2.5, lah, Malaysia's average. Okay. Now liquid, you can access it within the next 1 to 2 business days. The best case scenario is instantly, lah, which is what digital banks are offering right now. Low to no market risk, which means if the market does something like this, you will still get to retain that value over there. That 30,000 ringgit stays at 30,000 ringgit. The interest that you earn won't get lost. Which goes to the next point. Yeah, fixed deposits. Some people are still thinking that it's a good place to store emergency funds. Sorry to spoil your day. It's not a good place because FDs, they are not liquid. Sure, you can redeem them anytime, but now there's a market risk already because you will lose the interest that you generated for the entire year, right? So rather than putting emergency funds into fixed deposits, sure, it beats inflation. Well, there are so many other options that allow you to withdraw instantly and you do not lose any interest as well. Current accounts, saving accounts, short for CASA, such as Maybank saving account, CIMB, Octo savings accounts. Yeah, those are pretty hopeless. Those only generate you 0.1 to 0.2% per annum. It doesn't even keep track of inflation at all. So not a good place to store emergency funds. Now, what Han has covered during his session is that EPF account 3 could be a good place. Because now, I'm sure you guys are familiar, 10% of your EPF funds can be withdrawn anytime and liquidated within the next 2 working days. Yeah, he has tried this out before. No market risk. It generates 5.5 to 6% per annum. So it's a choice for you guys. If you have the option, let's say you previously were struggling to build up sufficient emergency funds, probably it's a good opportunity to look at your EPF account 3 and add it up together with your emergency funds to see if it meets this criteria over here or not. And if it has already met this criteria without you needing to touch your EPF account 3, well then obviously you're at a very good start. Okay, and you can afford to invest part of your emergency funds previously to riskier assets to generate you healthier returns. Because again, you're using EPF account 3 as part of your emergency funds, right? So yeah, it's getting a bit technical, but anyway, got any questions can pop it over at the general chat later. Now next, what sort of risks that you should look out for? Okay, specifically how I built a portfolio like this, it's very complex, but it's based on this simple rule over here. Rule of 100, you take your age, okay, 100 minus your age, that is the percentage that you should be investing in risky assets for your retirement right now. Again, don't mix up retirement with short-term goals. So if you are 30 years old right now, okay, your retirement portfolio should be 70% invested into risky assets. Risky assets are those assets that generate 10, 12, or more than 12% returns every year, but they are also considered very volatile. So one very big hint about a risky asset, well, it's Bitcoin. And another one, here's the risk spectrum over here. They are local bank stocks, moderate risk. There is gold, moderate to high risk. US stocks and ETFs, those are considered high risk, right? Bitcoin, because it has the capability to fluctuate 50, 60, or even 70% in less than 1 year. Therefore, it's considered as extreme risk. So within your portfolio itself, these risky assets, they tend to generate about 10 to 12% return on average. Therefore, if your portfolio is 70% invested in risky assets, the math works out to be about 9 to 10% return per year. So I'm going to say this again. If you're 30 years old, the return that you should be aiming for is 9 to 10% per year, provided it's 70% invested into risky assets. If you're earning that less than 9 to 10% per year, then you're not really adhering to your own risk profile because you have the time that long time horizon to take sufficient risk and generate better returns. Okay, obviously you can invest in safer assets as well, like you just retire later, right? So now this risk spectrum is not exhaustive. There are many different types of riskier assets as well, such as P2P lending, etc., etc. And the confusion is here, right? It's like, okay, you show me so many assets already, but I don't know what to hone in on. I don't know what actually to invest in. Now, what Han shared is actually a mind blower. He says that the act of investing always beats the actual assets you invest in. So think about this. These assets over here, whatever you invest in, over the long run, it doesn't matter. As long as you adhere to the rule of 100, as long as these assets are generally considered as risky assets, you don't have to actually care too much about what specific asset it is. You get what I'm trying to say? Hopefully you guys get it lah. Okay. So the encouragement over here is to always start. Act now, don't wait. Okay, because it always beats whatever assets that you're trying to invest in. And over the long run, because now you're starting to put money into the market already, you're starting to take more risk already, you will start to educate yourself more because that's your own money already. You'll realize that, okay, now I have to learn more about this, learn more about investing, whatnot, and gradually your portfolio will adjust to something that fits your retirement. Okay? So the approach to dollar cost average monthly, time in the market has much more impact than timing the market. Sure, you guys have heard this before. So obviously, you don't want to hope to buy here. Obviously, everybody hopes to buy here, but nobody knows where's the absolute bottom. So rather than trying to time the market, you just, okay, maybe once a month during the 15th, I buy 200 ringgit of this asset. Then next month, same thing, repeat, 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 repeat. So you dollar cost your way downwards. And over the long run, I think you guys have seen the chart of Bitcoin, gold, and even the S&P before, right? It goes up and up and up. And because of your act of dollar cost averaging, you actually make quite a healthy amount of profits over the long run. Okay? So yeah, that's that. But another important question is like, oh, okay, Shinji, you talk about so many things already. But how do I get from here to here? Because I'm assuming that most of you today, your portfolio currently looks something like this. Maybe even more conservative than this, where you are 70 to 90% invested in EP, cash apps, ASB, ASM, you put some into FDs as well. And then previously you've been dipping your toes a bit into gold. Okay, put a bit into Bitcoin, something like that, less than 1 to 2% of your portfolio. So it's somewhere around here. Then today Shinji says this, right? Rule of 100. You're supposed to be 70% in risky assets. So how do I get from here to here, right? So for this, what I will say is that number one, you realize that you have time. Okay, because you're still young. Okay, you have a long time horizon, 15, 20 years. You're actually way ahead of the curve. And you give yourself the time. Right? Don't readjust your portfolio into this overnight because that involves moving a large sum of money. And after that, you're going to think a lot. You're going to be like, oh, but Bitcoin is $97,000 right now. Gold is near all-time high. Not so sure whether I should move all of my ASB, ASM into this particular asset or not. Yeah, so don't need to go through that, right? You give yourself some time and you give yourself a target, right? Let's say, okay, by end of the year, end of 2026, end of next year, my portfolio should look something closer to this than it is to this right now. So that I know I'm on track to take sufficient amount of risk in order to generate healthier returns for more comfortable retirement. Right? So that's giving yourself some time. And as time passes, you rebalance gradually. Now there's two methods to this. Number one, you rebalance within your portfolio. So every month, you take out from ASB, ASM a bit, or FDs or whatsoever, depending on your risk profile. You rebalance it to whichever asset or whatever risky asset that you want to get involved in. And number two is, let's say previously you've been always dollar cost averaging into ASB, ASM and putting some into GX Bank, Versa Cash or whatnot. Instead of doing that the next month, you put it into the risky assets. So that over the end of the next year, your portfolio will be closer to what your risk profile is. Okay, so basically that's dollar cost averaging into risky assets rather than safe ones. So hopefully this gives you sort of like a good idea on how to manage and think about your investment. I also didn't cover about the rule of 25. So bear in mind, this is just one section of Hans' entire four section where he covered about cash flow, debt, investment, insurance. Okay, so later, if you want to learn more about the rule of 25, you can ask me during the Q&A session and I'll talk more about it. But this is the cheat sheet, okay, to be ahead of 90% of the people. And I'll give you the quick summary of each of the points which Han has shared. Number one, cash flow, which is you save more than you earn. Basically, you spend less than you earn, right? And don't forget your annual expenditures. Typically, budgets fail because people tend to forget those ad hoc spending and those like 1 year spending, like servicing your aircon. You do that once every 6 months, some people once a year. Servicing your car, right? So when you forget those, right, at the end of the day, you have to plow in your savings and you realize that you're not achieving your savings goal. So all those annual costs, you add it up together, you divide it by 12, then you add that to your monthly budget. Okay? And then next is you pay yourself first. Yeah, probably you've heard of this before. But to put it this way, let's say you're afraid to miss your TNB bill, your prepaid bill, yeah, because you no longer have access to Wi-Fi, right? You should be very afraid to pay your future self as well. So basically treat yourself like a bill. Set aside 10, 20% of your salary or any figure that you're comfortable with to save towards your emergency funds, number one, first priority. Then only invest long term towards like a 70-30 portfolio, depending on the rule of 100, right? So next one is debt. Now keep all debts good, pay the most expensive ones off first. This sounds like advice that you already know, but to go into a bit more detail, good debts typically have less than 5% interest per year. Okay, if you're paying more than 5% for your debts, those are considered more expensive debts. You should prioritize paying them off first. Now another check is to only take on debt if that purchase is for an asset. You don't use debt for consumption. Give an example. Using debt to go for a holiday, yeah, that's for consumption. That is bad debt, even though the rates are low. Okay, using debt to buy a new handbag, that's for consumption. That's a bad debt. Again, even though the rates are low, right? But conversely, using debt for education, right, because you get a degree, that degree can help you generate more money. That's considered as an asset. That's a good debt. Another example, using debt to buy a car. A bit controversial, but let's say you need that car to drive you to work that generates you more money, right? And it's a car that you can comfortably afford, then sure, that's considered as a good debt. So next one, investment, I touched on it already. And finally, insurance. Now this one is also a bit of a mind blower for me. You buy insurance for protection, not for investment. Majority of the people today are paying way more for insurance. Why? Because a lot of those plans, they are linked with investment. And today, I've already talked to you about investment, what sort of risks you can take, how your portfolio should look like, whatsoever. Then it doesn't really make sense for your insurance plan to include investment as well, right? And that is one of the main reasons why insurance plans are pretty expensive. And according to this order, you should prioritize medical, critical illness, personal accident first, then only think about life insurance if you have dependents. Yeah, that's according to Han. Now, today's session, obviously, it's a half an hour long, but it doesn't do Hans' session justice. It doesn't even come close to what he has covered in this whole 2 hours. So highly recommend you guys, if you're Patreon members, I think the replay is sent in the WhatsApp group. So go and check it out. You'll probably learn a thing or two. So first one we have from Kana. During the financial planning talk, oh, thanks for attending, by the way. The two case study portfolios mentioned that their goal was to retire at 45 years old. Since EPF is only accessible at 55, should we consider it as a part of the fixed income allocation in those portfolios? Okay, very good question. So for those of you guys who don't understand what we're talking about, right? During the session itself, by Han that day, people were allowed to submit their portfolios. And they are required to give some of their details, i.e. how much they're earning per month, and most importantly, what is their target age for them to retire. So both of them chose the age of 45. Now, should you include your EPF section as part of fixed income or not? As part of like the 30% safe investment, okay? And I say you should. Why? Because if your target is to retire at the age of 45, you must include EPF because at the end of the day, when you achieve your target at the age of 45, you won't liquidate your portfolio entirely immediately, right? You will just liquidate a small portion of it and it will definitely last you for the next 20 to 30 years, from which by that time, you're age 55, you can start to access your EPF funds already. So yes, if you're investing for retirement, always include your EPF portion, even though it's before the age of 55. And by the way, uh, you can get to access your EPF funds before the age of 55. Actually, you can withdraw out, I think, your account too. If I'm not mistaken, I have to double check on this lah. You can withdraw your entire account too, or 30% of your entire EPF account previously, and at the age of 50. Okay, so even before the age of 55, you'll be able to withdraw a portion out already lah. But nonetheless, if you are planning for your retirement, always include your EPF portion. Because if you exclude that EPF portion, now your entire portfolio becomes much more conservative already. Because why? You have to allocate a specific section for conservative assets, where previously it could be entirely covered by EPF. And that 70%, you can be taking more risk, right? So yeah, hopefully that makes sense to you lah. So next one from I am a mistake. How would we classify risk of equities in our portfolio based on sectors? For example, a 100% equity portfolio. For instance, if 20% of my portfolio are in tobacco and banking stocks, which aren't as volatile, while providing a steady flow to offset tech stocks, would that still be considered high risk since they are in equities? Would exchange traded funds still fall under high risk categories? So two parts to this. I guess generally when you're investing in stocks, right, it's considered higher risk compared to whatever safe assets that are here right now. Because these safe assets are typically invested, okay, exceptions for ASB, ASM, and EPF. So we talk about cash apps first. Okay, your Versa, your Mumu Cash Plus, right? These places typically invest in what we call that government securities, i.e. bonds or in banks as well. Okay, so they are relatively low risk. Now the exceptions are ASB and ASM. They are considered low risk, but then again, it's a bit controversial over here because ASB mostly invest in Maybank, Tenaga, Public Bank, right? All of it is stocks. But we look at the returns that they've generated and considering its share price is always fixed at 1 ringgit, right? You can safe to say that it's a pretty low risk asset lah. Okay, again, still debatable, right? So EPF also the same thing, even though it's like 60% invested in equities, I think, right? It is still considered low risk because considering its historic return, right? It's delivered 5.5 to 6%. Never do you have a year where EPF returns are negative, right? So these are typically considered safe assets. I guess those risky assets are those ones that can go into negative territory. Yeah, like stocks. So that tobacco thing which you mentioned just now, even though you may say that tobacco and banking stocks are considered safe, but they go through periods where they are volatile as well. Give an example, Maybank. Okay, so Maybank, even though a lot of people say, wow, very good banking stock, right? Very stable one. But if they look at the history of Maybank chart itself, they basically are shooting themselves on the foot. And there was a time when Maybank declined by, let's see, 64% in 3 years. Okay, so it's considered risky, but probably not as risky as your small cap tech stocks or perhaps Bitcoin or whatsoever. Okay, it is considered a more stable investment, still risky by the way, more stable investment compared to other stocks. Okay, based on its volatility and track record. So the answer to your first question is this. It's still considered to me as risky, but I wouldn't say it's very high risk lah. Okay, but within the equity section, probably is considered as medium risk. But within your whole portfolio section, right, you probably might want to put it here. Okay, so that's my take on this. Next one, would ETFs still fall under high risk categories? Now, ETFs, for those of you guys who don't know, is short for exchange traded fund. Okay, now exchange traded fund, it looks something like this lah. I show you a QQQ. Okay, so the QQQ is what we call an exchange traded fund. What it does, it's basically invests in a basket of goods to track a particular index. Now this is getting a bit technical lah, but the job of the QQQ is to basically track the performance of the 100 best companies listed on the NASDAQ. So another index that you can refer to is the S&P 500. Okay, if we put it as the same scale, you can see that it's almost 1-to-1. So what the Q, sorry, my computer is doing something funny today. I can't seem to drag this. It's actually lagging out. But you can see like pretty much the QQQ moves very closely to the S&P. Whereas because the QQQ tracks 100 of the largest non-financial companies in the US lah. So it basically, in a way, it tracks the S&P 500 index lah. So my answer to your question is this. The exchange traded fund itself is high risk if it tracks a high risk index. Okay, so there's even something like a gold ETF, yeah, from Malaysia, in fact, this gold ETF, right? So this gold ETF, because it tracks gold prices, and if gold is considered a moderate to high risk investment, that ETF is considered moderate to high risk. So you also have ETFs that track fixed income or the performance of the banking sector, right? That's considered generally lesser risk. Okay, so it depends heavily on what type of ETF that you're investing in. If you're investing in a high risk ETF, obviously that would fall under the high risk category. So last question from Kana. If you guys have any questions, just send away. I'll still remain in the chat for the next 5 to 10 minutes after I end tonight's session. So Kana asks, how much percentage is acceptable to pay brokerage fees for transactions? My plan is to dollar cost average into ETFs every month. However, I can save up on platform fees if accumulate and DCA every 2 to 3 months instead. So these days, brokerages, right? The listed brokerages are regulated ones. They're M Plus Global, Mumu, Webull, as well as Rakuten. These four, right? Their fees are quite competitive. So it kind of like, I wouldn't want to say this, but over the long run, it doesn't make that much of a difference. Because like what I said just now, the act of investing itself is much more important than what you actually do. Okay, just do it, and then that will actually lead you to financial freedom. Not like being a bit skimpy on like where's the best platform to invest or whatsoever. I know we futurists always compare which the best platform to invest, which one is to save, but the most important point you have to know is this. You just gotta get started. Doesn't matter where you get started. Now, if you still want to look into brokerages that have the lowest fees, I've done one for Webull before. So spoiler alert, they've paid me to write this, but just nice, their platform is the lowest fees. Okay, so even though I'm not paid to say this, I will still tell you that Weibo has the lowest fees right now. Okay, not advertised. So this is the fee structure over here. Later I will send it to you guys. So for the first 90 days, Weibo is not charging you any platform fees or commission fees. This is slightly lower compared to Mumu. Mumu is charging 99 cents per order, much lower compared to Rakuten and M Plus Global. So now obviously if you're dollar cost averaging, you're going to probably say that, hey, Shinji, don't tell me a lie lah. This makes a huge difference lah, okay? But over the long run, you will understand what I'm trying to say lah. It's much more important to just get started than, trying to skimp on things and take some time to decide lah. Okay, so that's the most important thing. Okay, but anyway, this is the lowest fee, so I will just attach this fee structure over here so that you guys can have a reference. Okay, and you can go and check it out yourself. So next question by Darren. What is the difference between investing in Bitcoin with Luno compared to buying it on Momo? Now, I'm actually not aware that Momo offers Bitcoin investment, but I'm going to assume that whenever you buy it on Momo, it's a Bitcoin fund. So this touches on what the previous question is actually, ETFs. So Momo, what is most likely, the Bitcoin fund itself is probably an ETF, an exchange traded fund that tracks Bitcoin prices, just like this gold ETF over here. So now ETFs, they will typically own the asset itself lah. This ETF, this Shira Gold Tracker, they will typically own gold bars one, but they have to reserve like 1% or 2%, right, as cash, so that for any investors that want to liquidate their investments, they have to honor those withdrawals. That is the difference. You're not exactly 100% exposed to gold. You're actually 99% exposed to gold. That 1% is to honor your withdrawals. Okay, so the that's the big difference between investing in Bitcoin and Luno. compared to buying it on Moomoo. Now, when buying it on Moomoo as well, you do have the platform fees, like what I said over here, right? And you do have the fees charged by the exchange traded fund itself. Because when you buy unit trust funds, probably sure that you're aware of this as well. Every year they charge annual management fees, annual trustee fees. But the fees for exchange traded funds, because their job is to just track gold prices or Bitcoin prices, are typically very low, are about 0.3, sometimes even less than that, 0.4%. So I know that Versa's gold fund is actually this gold fund over here. So when you invest in gold through Versa Gold, right, you're basically investing in this Sharia Gold tracker, which the fee is 0.33% per year. Okay, so for Bitcoin's case, on Momo's end, you probably would have checked the fees lah. Okay, then there might be a difference over there. But when you buy Bitcoin through Luno, you are buying the real deal. You're buying the real asset itself. Yeah, you can withdraw that Bitcoin out from Luno and send it to your own cold wallet. You're basically practicing self-custody, holding Bitcoin for yourself. But when you buy it on Moomoo, you are actually buying a fund that buys Bitcoin. Okay, so hopefully that gives you a good idea on where you want to buy it. Okay. So yeah, thanks so much for joining, guys. I see quite a healthy attendance today. So do join. I think I'll probably conduct more sessions like this. I think you guys like this. So if you guys like it, let me know so that next week I'll try and conduct a session like this as well. If you missed the earlier part of the session, don't worry. I'll proceed to edit it tonight and I'll post it by Wednesday. Unless you remember. If you remember, you can access it tonight. Okay, so if you want to join our WhatsApp group, you just click on notifications. There are two links right here. You can sign up through Patreon or you can sign up with me directly lah. Okay, so two choices. All right. I'll see you guys next Sunday. Bye. Thanks. Stay safe.